Hey, hello people. So today we are going to talk about how to choose the right mutual fund for yourself. So now there are many methods to analyze the best mutual fund for you, but in this video we are going to cover three methods that will help you to choose the right mutual fund for yourself. So the three parameters are performance matrix, expense matrix and AUM. So let's start with performance matrix. So in performance matrix, there are many parameters to go through. We'll go one by one. So in performance matrix, the first parameter is historic returns. So now, just for example, I'll take quant small cap mutual fund and I have to invest for let's say for 3 years. So for 3 years, the historic return was 27.40% annualized. Now it's a good return. The second parameter in performance matrix is consistency, and consistency can be determined by rolling returns. So basically, rolling return are the average return of a mutual fund over a specific period of time calculated at a regular interval. So for rolling returns, I have to just come to Rupee West website and then I can get the rolling returns of quant small cap mutual fund over here. So now let's compare it with Bank of India small cap fund regular growth. Now as we can see, the average return of quant small cap is 44.28%, but whereas the average return for Bank of India small cap fund is 34.18%. Now they both have not delivered less than return from 0% to 20% in last 3 years. So it is a very wow moment for us. Now quant small cap mutual fund has delivered 6.33% times return in the bracket of 20 to 30%, whereas Bank of India small cap fund has given 28.51% time return in the bracket of 20 to 30%. So what this tells us that Bank of India is more stable fund as compared to quant small cap mutual fund. But as we see ahead, quant have given more than 30% of return 93.67% times, whereas the Bank of India's return more than 30% time is a bit lower than the quants. So I'll choose quant over here because it is giving more return than 30%. Now the third parameter in performance matrix is standard deviation. Let's understand standard deviation first. So standard deviation tells us how much the fund's return has deviated from its average return over a period of time. So basically it tells us how riskier is the mutual fund is. Now let's understand it in the screen. Now to understand standard deviation and all the other parameters which I am going to cover in this video you can get all those parameters in Value Research website. So after I scroll down, I have selected sample mutual fund which is quant small cap direct growth, and I am comparing it with Nippon small cap fund. So here if I scroll down, then I get risk ratios. That's where we have to go. And over there we can see standard deviation. So again, as I have told you earlier, the higher the standard deviation is the better. This tells us how much the mutual fund is deviating from its mean point. So let's see, standard deviation for quant small cap mutual fund is 17.41%, whereas for Nippon it is 14.96. So that means quant small cap fund is deviating more than Nippon. So it is a bit more riskier than Nippon. So let's get to our next matrix, which is Sharpe ratio. So it tells us about how much the extra return a mutual fund provides for the risk taken per unit. Now let's understand it. So let's suppose the Sharpe ratio for quant is 1.29 and for Nippon it is 1.46. So we can clearly see that Nippon is making extra return over the quant, as its Sharpe ratio is higher than quant. The another parameter in performance matrix is called beta. Beta, it is a measure of how much a mutual fund returns move in relation with its benchmark or the market. So in the table we can see if the beta is less than 1, then the risk is low. If the beta is equal to 1, then the risk is equal. If the beta is more than 1, it's a high risk mutual fund. Now let's see for our quant small cap mutual fund and Nippon. So beta over here is 0.93 and for Nippon it is 0.82. They both are in same category. Let's say they are both in low risk categories. The last parameter is alpha. So alpha measures the excess return over the benchmark on the risk adjusted basis. Again, the higher the alpha, the better it will perform. So alpha for quant small cap is 5.94, whereas for Nippon it is 7.46. So in past years we can say that Nippon has performed better than quant small cap mutual fund. Now our second matrix is expense ratio. So as we can see, the expense ratio for Nippon is 0.68 and for quant it is 0.64. So the lesser the better. So I'll just pick 0.64 returns, 0.64 expense ratio, that means quant small cap mutual fund. Again, we have to see exit load. So exit load, if you redeem your mutual fund before 1 year, then only the exit load is charged to you. If you redeemed it after 1 year, so there will be no exit load charged to you. Again, the exit load, the lower the better, but so here it is same for both of the cases, it is 1%. Now the third matrix is AUM, which is asset under management. So as we can see, the net asset for quant small cap it is 27,000 crores and for Nippon it is 61,000 crores. So in such a niche market cap, we should always go for smaller AUMs because they will outperform. Thank you for watching.